Okay, well, in theory, we're recording at the moment. We'll see what happens at the end. All right. So, any particular thing you want to throw out there, or you want me just to start in with what I was thinking?
No, I think you can just go ahead get started.
All right. So, what I did here is I grabbed a few images that I've collected that's are kind of pertinent to what we talked about yesterday, and thought might help. So, like this first one, this is that whole concept of what we just talked about, but it's got this visual of the open orders on the right hand side in relation to price, right?
Okay.
So kind of showing this zone right here and showing, hey, there's a lot of orders here, but once price really takes off, notice they thin out, right?
Yeah.
So that's kind of the balance concept and the imbalance concept. So as something like this happens, some of these are getting used up, but because it moves so fast, probably not all of them, which is why what we're doing works because you're not doing what most people do, which is, maybe somebody's looking at the fundamentals, earnings reports or news, trying to figure out, you know, what the next move in the price is going to be. We're stepping back and we're looking at what are other traders actually doing and what have they done so we can choose a high probability path based on what is really happening in the background, not what we think is going to happen, right?
Hmm.
So that's the whole idea there. And then going to here, this one always caught my eye because here they're drawing these two zones and they're saying, hey, when you're in that area, what's the right question to ask? And that's kind of what we're going to try to do a little more of today because you always want to look at both sides.
Hmm.
If I'm kind of feeling like I'm bullish, always ask the bearish question as well, so that you don't limit yourself or get yourself, focused a little bit too much on confirmation bias. And then, so the guy who actually started this concept of supply and demand, which was, I think it was roughly 15 years ago or something, and he was doing it for an online trading academy as he was a teacher there. And he no longer works there. He has his own side business where he teaches this stuff. But he came up with some of these base concepts. He is still using the stuff he came up with, but a lot of the things I've already showed you and have left to show you have come from other people who have really added a lot to it. But the base concepts are still there. So, for example, on the left side, it says two types of continuation. On the right, it says two types of reversal. So notice the big candles going up, balance up, or in this case, they call it rally, base, rally. So when you kind of see this, you're generally in a bullish mode because you're seeing these big candles where you know there was an imbalance or a price push to move up, and then a little balance, and they did it again. So there's probability that this is telling you, hey, there's more buyers generally going on right now. This is more bullish at the moment. And the opposite is true when you see that drop, base drop, right? So granted, when you're
Okay.
in this area, you're trying to figure out what the next move is, down or up. And of course, here we've got a big clue that says, hey, we got a big drop here. So I'm kind of leaning towards the next one as a drop, but you don't know that.
Right.
And that would prove this point right here. Now you go into what's called a drop base rally or a rally base drop. So just terms to, to keep us on the same page there. Drop base rally, drop base drop, drop base rally,
Hmm.
rally base drop. That's all that is. And you can see how they've drawn the lines here a little bit different. They've drawn them over the course of the entire zone versus focused on the particular last candle just before the big rally. Honestly, it's all good. I think it's a little better to focus on this previous candle and the wicks based on my
Hmm.
experimentation. But the longer this base, the more this concept makes sense. The shorter the base, the better this candle is. But there's really no perfect right or wrong.
Mhm.
Okay. So now here's what I'm going to we're going to try to go down into a little bit more detail today of, now you're seeing these big blocks on where the turns are. Then the question is, how do you know if it's going to turn? How do you make some estimate of which direction it's going to go? So this example, you got price going sideways in a range, and then it pops down below it and suddenly pops back above. Well, they call this kind of thing a manipulation. And this is where um, either the term manipulation or stop hunt would go, because you've got people over here, some are betting long and some are betting short because it's in a range. So as soon as this breaks out below that range zone, there's a whole lot of people that call that a breakout trade and they're immediately going short, right?
Mhm.
So, but if there's really more buy orders in this area, these breakout traders are going to get trapped because those orders that are sitting there, um, or potentially up here that are attracting more, are saying, hey, these guys sold. That's fine for me. I'm going to buy because I know this bad boy's going up. So if you see that little pop down below and then back up, that is what manipulation, liquidity sweep, stop hunting, it's all the same kind of idea, just different names, right? Because that's what the real money needs. They need to go out and hunt for orders in order to get to transfer a large amount of money from you to them, right? That's their goal, right? So
Mhm.
they're always looking for those constant retail things that retail traders are taught. Place your stop loss just below, or when it breaks out, um, that's when you place your buy order. Well, so many people do that that the banks really just and the smart money really just kind of does the opposite. They look for those areas and go, hey, I know there's orders there, so I'm going to kind of push this from here down just a little bit, you know, and by selling a block of shares, that'll push the price down, and then they'll see what happens right here. And if all of a sudden they get some breakout trades, but there isn't massive selling, they're going to start absorbing that and push it back the other way. And now
Mhm.
suddenly they've bought more shares at a lower price instead of at a higher price for their continuation into the long direction. Right. So you always got to it's thinking about what retail trailers really do and what the smart money is really doing, and we want to jump on the coattails of the smart guys, right?
Mhm.
There's no reason for us to figure it out. We just got to follow them. All right. So here's like an example of something that ties in real close to what you were doing. Um, here's where the block was drawn, right?
Mhm.
And it pulled away really, really fast. Well, the purpose of drawing that block is because you're saying, hey, if price gets back to this area, the question is it a high probability sell again, or is the price going to go right through, right? Well,
Mhm.
one clue is how does the price come back to that zone, right? If it comes back like this, what they call a corrective run, back and forth, slowly moving its way up, or in steps, that is going to be a high probability when it gets back to here that it's going to go make another run down. But if it pops down really fast and pops up really fast, chances are that's a fake out, and it's going to go right through this bad boy, right? Or at least slow, you know.
Mhm.
So that's another little clue.
Okay.
And let's zoom in on this bit a little bit. So this guy, he's on Instagram and he puts out images all the time. And they're pretty good images. So this is supposed to say liquidity grab plus flip, high probability trade is what he's saying. So up here, you can see, you know, this zone comes from the past. It comes up and it mitigated this supply by going into here and it goes down. Okay, so we know that part. He's drawn another block here and it did definitely turn, right? It comes back. So here is the first place where it breaks any structure, right? And in
Hmm.
his terms, inefficiency, that's the same as saying imbalance, where he would call that areas like this efficient and this area is inefficient. A lot of people say
Okay.
balance and imbalance, same thing. And this concept of flip is going from bullish to bearish. You've had your first, you know, just like when we drew the structure of the lines on there, you've got your lower high, and now you've got your first break of structure going the other way. So when you get your first break of structure going the opposite direction, they call that a flip. Because
Okay.
suddenly the concept is the probabilities have flipped bearish versus bullish, right? So you're always looking for things that'll make it stronger or weaker. And where in general, if you go to a lot of classes, they will teach you you're always looking for strength, you know, as the price as price is going up, or weakness as the price is going down. Or yeah, you gotta. I had a couple of mentors that said, no, 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 flip that around. Look for weakness on up bars and look for strength on down bars, which is exactly what we're doing here because, for example, if you go into a supply zone, that bar might look strong, but it's going into an area that it's going to get absorbed, right? So that's really strength in the bullish side. Again, it's just flipping the question on end so
Hmm.
that you don't get yourself caught in confirmation bias. Okay, so we break through. It's coming down. It's kind of going down sideways like this. And again, that's liquidity in a different way. We're going to look at this in a couple different ways going forward. Comes down. You see here's the swing break. It actually pops down. And one of the things we're going to look at, cat just keeps coming back. Yes, you don't come when I'm out on a meeting. Um, so it comes down, it actually breaks that structure, and that's like, you know, more of a probably a bigger structure, right, than something like this because
Hmm.
we can't see the rest of it, but it breaks that. Whenever it breaks structure, one of those things that I told you was like we got to try to figure out where those high probability zones are that we want to really look at. Well, once something breaks structure, you know at some point shortly thereafter it's going to turn back. The question is where, and the question is how far. So anywhere in those zones of a very clear um, market structure break, or break of structure, those are definitely going to be higher probability points because we can absolutely see price turned there. Therefore, we know something's going on there, right? So that's one high probability zone. So here, notice this, and he's written the word trap and break of structure because here again, it went up a little bit, comes down. We definitely broke structure here, right? So people are going, hey, that's a breakout trade, right? Because we got below there. But look what the next candle did, right? So if you were in this and you had agreed with that, yeah, it's a breakout trade, I'm in. If this goes against you immediately, you got to say to yourself, I'm wrong, get out,
Hmm.
right? But the reason this was a trap is what we're going to learn in some of the details is looking at these wicks now in more detail. Because notice how this has come down and you can see the wick kind of comes down to about there and then closes right there,
Hmm.
right? Well, the next candle did what? It opened here. At some point, it got all the way down to there and it closed up there. Well, this day went down below this day and bounced way up. So what had to happen there? It had to find liquidity there in order to make that bounce, right? So by going down below this area, we found buy orders. We found more buyers or more sellers than buyers, right? So so those buyers overwhelmed the sellers that were sitting there, and it popped right back up. And that's going to be a key. These little pops below, that's the manipulation. Let's go down below or above, as the case may be, and let's see what happens. Once we see what happens, now we've got a clue. Does that make sense? Or no?
Sort of.
It's like peeking around the corner when you're
So
playing hide and
I,
seek,
I
right?
yeah, I think I get why um why that wick kind of went down below on that white candle. Um, but it still ended up quite a bit above the previous day.
Yep.
So I don't understand what the trap was.
The trap
Like
here, he
why is it a bad thing to get in there if the next the next candle it went up?
well, if you get in here, that's you're not the one that's trapped. It's the people that have gone short here because of this breakout, okay? That said, hey, there's a breakout. I'm getting in to go short. And you, let's say you didn't do that because most of what our rules say is we need a little more information than that.
Uh-huh.
The next day comes along, we see that come down below here and pop back up. We know that all those sell orders have now been absorbed into more buy orders, and we've closed above those points. So the price action has gone down below, said, hey, there's more people that are interested in buying here, not selling, and it's pushed up. So those people that sold are trapped, not you, right?
Oh, the people that sold. Oh, I
Right.
understand. Okay. And we wouldn't even get in until probably
Yeah, some
after this white candle had already ended.
yeah, maybe as this one's getting towards the end or maybe the next day. Right?
Right.
That would
Okay.
be the soonest you could
Okay,
possibly
that
get
makes
in
more
there,
sense.
right?
That makes more sense to me
That would
now.
be the soonest.
So it's
So,
a trap for the people that were selling there.
yeah. And like so many things, you may not know it's a trap until the next day, right?
Correct.
But it's only going to happen, traps are only going to happen when you start breaking structure like this, because or when you break out of some kind of a pattern. I think you've heard of channels and triangles and all these other things, right? Or no?
Mhm.
Yeah, so lots of people play breakouts of those things. Well, if it breaks out and goes back into that area, that was clearly a trap because there were more buy or sell orders in some location that breakout traders don't look for. They're just looking for it to cross a line and away you go. You and I are looking for at zones and lines and going, hey, I know there's buy and sell orders here, right?
Mhm.
So I'm not just going to do it because price moves up there. I'm going to see what it does when price gets to this area and then I latch on,
Okay.
right? So we pop up, right? And it goes up to here. And notice here's the area. It goes all the way back up to there. And in this case, God bloody hell. Arr. Come on. There we go. So in this case, you see that one didn't quite hit the zone, but the red one did, right?
Mhm.
So in this case, it was very, very similar idea. But this looks so strong to people. Most people are going, wow, that's a really strong day. We got to keep going. There's no question about it. But you already know about this place. So you're looking to see what happens. And as soon as that price goes back this way, and let's say it gets anywhere below there, you're going, that's a reaction off of this zone. I'm going to sell,
Yeah.
right? And then you put your stop loss like right in this area so that it's very, very close, right? Or most people would put it, I guess, above here. But that way, if you sell here and your stop loss is there, even if you're wrong, right? you've only lost a little bit, and the next candle might trigger you right back in, right? So as long as you
Can
see
you
the right setups,
can you explain a little more what exactly a stop loss is?
yes, yes, yes. So stop loss, for example, when you're bullish, I don't know, because that's the easiest description. Let's go here. Down here, you're going to say, I'm buying, right? So let's just say
Sure.
this is $100 right here, make it easy.
Hmm.
You buy in at $100 and you buy 10 shares. So you got $1,000 riding. Well, at the same time you put that buy order in, before you actually put that buy order in, you want to be thinking about what happens if I'm wrong, which means if this price goes down instead of up, you want to say, at what point am I getting out if I'm wrong? So if it goes down to what, $99, 98, 95, you have to make that decision and say, okay, if it goes down to $95, I'm definitely wrong, and I'm going to put in an automatic order, which is called a stop loss. So if price reverses against me and gets to 95, I will get stopped out automatically by my order, okay, that I've put in the
Hmm.
market. I put it in at the same time I put in a buy order. You don't have to, right? But you can, right? So,
So it would immediately sell once it got down to 95.
right, exactly.
Okay.
So,
Then
oh, go
can you
ahead.
explain it on the other side? Because you had
Short,
said
short
put your
side, yeah.
stop loss above that supply zone.
Yeah. So up here it's the same concept except for you're initially selling, right? So now let's say you sell right here and it's $150, right? Well,
Hmm.
if you sell here, you want the price to go down. Let's down here is $100, right? So
Hmm.
if you sell at 150 and buy it back at 100, you just made $50, right?
Okay.
Does that make sense?
Yes.
Okay, so now you're selling at 150, but if the price reverses against you and goes up, and let's say this is $155 right here at the top of the zone, you put a stop loss at 155.50 just above that zone so that if price does reverse against you, it'll hit that stop loss and knock you out of the market automatically with a very small loss instead of it just going up to here and you losing a lot of money. It's exactly the same, just opposite.
Okay. I'm still
Okay, we're gonna do
a
this a
little
different way.
confused because if you're selling at that point anyway,
Here's
what's the
okay.
point of putting it higher?
Okay, so here's the deal. There's buy to open, sell to close, and then there's sell to open, buy to close. Okay? The difference is when you're going long, this is the most common thing everybody thinks of. If you buy down here for 100 and you sell up here for 150, you just made $50, right?
Sure.
Okay, that's called buy to open, sell to close. Up
Hmm.
here, I'm selling to open, meaning I'm opening a new trade, and I buy back down here to close. That's shorting versus going long.
Okay.
So now right off the bat, you're saying, how can I sell something I don't own, right?
Yes.
Okay, but in the stock market, what happens is your broker, if you want to sell something you don't own, your broker will go out and they'll look at all the shares that are in the pool of things that are in their clients and say, okay, I'm going to borrow these shares that are sitting in someone else's account and I'm going to loan them to Gabe and Gabe is going to sell them, right? So there used to be always a big fee for that. You know, you'd have to pay some percentage. Let's just say 5% for now, right?
Oh, I think I get it now.
Right.
So you just basically you have to pay them back the stock, not necessarily what the stock was worth.
Exactly.
Ah,
Exactly. exactly, because they don't even know that you're borrowing them. The broker is just doing all these transactions in the
Yes.
background, right?
Yes.
So
Right.
so usually the broker gets a little fee for that. Used to be, 1, 2, 3, 5%. Now I
Hmm.
think in most cases for small traders like us, I don't even think there's a fee for that anymore.
Hmm.
But it can be. But at any rate, you're borrowing the shares, you're selling them. So if it goes down in your favor and you buy it back at a lower price, now you can return the shares to where they were borrowed and keep the difference.
So for the purpose of the stop loss above, just slightly above that supply zone, if you sell those borrowed stocks right at the top there, you don't want to let it continue going up. You want to stop
Right.
it so it's minimal losses when you have to quote
Exactly.
unquote pay those stocks back.
Yes, because if you
I
sell it
understand now.
at 150, but you have to buy it back to close at 155, you've lost $5.
Correct.
And you still have to return the stock, right?
Yes.
So you have to take that $155 stock, return it to where you borrowed it for 150 and absorb the $5 loss.
Hmm.
So it's really exactly the same as going long. The difference is the broker's
Yes.
doing that little manipulation and borrowing in the background.
Okay.
Right?
Now I understand.
Right.
Now I understand.
So, but now the caveat to that shorting concept is, of course, sometimes the brokers will get fees, and
Hmm.
sometimes when things go against you that fast, it happens very, very quickly. And the broker is going to be monitoring your account because now this is effectively a loan, right?
Yeah.
And they're going to say, hey, you've only got so much money in your account, and this is going against you. And the risk is right now on the broker that you may have to pay it back, right?
Hmm.
If you don't have enough money in your account. So they might call those shares back at any time. You have no control over that. And if it's going against you, they might say, you don't have enough in the account to cover this, or we're not comfortable with your account. We're going to call those shares back, sell them for you, and return them to the owner,
Uh,
right?
so you don't always have
It's
control to, maybe wait as long as you would like.
exactly. Now, if it's in your favor, right, it almost will never get called back, okay?
Right.
Because the broker is going to get return on his funds, okay?
Hmm.
But what happens if that pool of shares that they were borrowing it from, let's just say there's one guy that had 100,000 shares and you borrowed 100 of those, right? And let's just say he put in a sell order to sell all 100,000 shares of his, and the broker doesn't have anything left to buy, right?
Hmm.
That's going to get called back from you immediately, even if it's in your favor, because the broker has to give those shares back to that person, right?
Yeah, because they're the true owner of
Because
it.
they're the true owner, right? And mind you, that could be over multiple owners. They don't have to get them all from one place, right? It's just
Right.
because in their bucket, it's just a big pool of shares with people's names assigned to them, right?
Hmm.
So that's another thing in the short world that there's always you don't have control. When you're in the long world, you have total control. You can sit on losses your entire life if you want, right? Because they're your losses and you're not affecting anybody else's account but your own, right?
Mm.
So that's a little bit of that caveat of the short selling. But you can make money up, down, or sideways. It's just a matter of knowing how to put in orders and how to protect yourself,
Yes.
right? So, sorry, I should have explained the buy to open, sell to close, sell to open, buy to close kind of thing before we started, but
Yeah,
I
that's
forgot.
right.
So so now you can see where this actually tapped into that and did its run. And this guy, what he did on here is you can see a little light color here and the red down here.
Hmm.
Well, I'm going to show you that tool in TradingView today, but it's a tool you can draw on a chart to show you where you're going to put your stop loss zone and where you think your profit is going to be before the trade happens, right? So picture this color on here before this all happens. Well, it goes in there, it taps in, you buy, you sell, you get in, it's going, and this would be his target, right?
Hmm.
And so let's say it reaches his target and he's chosen to buy back the shares at this point in the game, right? Well, then it worked. So what you're going to see is a lot of these, if you go exploring and you start looking at other supply and demand training out there, what they do is they're very much relying on determining where these zones are so that they'll identify, okay, here's a zone. I'm not going to trade until I see a high probability turn here. So it might bounce all the way down, finally get back up to here. Then they're going to probably look for a trade because they have determined this is a high probability turning zone, right? So the way I'm showing you, you're going to be able to do that as well as what we talked about, like here, we're going to be able to see, is there enough probability here for me to take a trade here, as well as know it's ending here and I can get the hell out and take another trade this way, right?
Yeah.
That is my goal, is to be able to find these swings. That's a swing from, peak to peak, or from valley to peak, or from peak to valley. And maybe if we can take, let's say, 80% of the middle as often as possible, that is so far beyond what most people do, right?
Hmm.
Um, because most people set these 15 or 20% stop losses, and then they wonder what the hell happened to all their money, right? Our goal is to set a very small stop loss, and we're either going to be immediately right or immediately wrong, and doesn't matter if you're wrong 5, 6, 8, 10 times in a row. As soon as you become right, you're going to recover those losses very, very quickly, right?
Yeah.
Um, so that's how this guy looks. And then here's another chart that's a little cleaner, and it kind of shows you what we did in the beginning, where he drew this line over the price action. He put it off to the side so you could get like different views, right? And just notice how he's drawn this line here, and he's drawn this line as more of a range,
Yeah.
not an order block, right? You can see OB, he's drawn his order block here.
Mm.
But see this pop up and above and back in? Well, that's the manipulation, right? That's a,
Mm.
hey, something had to drive the price up and then back down. So what's going on there? Well, and you can see what ultimately happened is it went down, right? So when we get on the other chart, I'm going to kind of show you how to look at like every candle and decide if it's any information at all, um, just based on these wicks concepts, right?
Right.
And so
So
he
like
put,
that tall wick there is kind of a sign that hey, someone was testing, to see if it would break through,
yeah,
but it failed and it just kind of kept going
exactly.
forward a bit and then down.
Yeah. In the candle world, that's called a shooting star, right?
Okay.
And if you were just a true candle trader, you'd say, oh, that's a shooting star. That's a bearish sign. Well, in the supply and demand world, that's a shooting star candle. The manipulation has happened. It's a high probability turning point, right?
Hmm.
So, because obviously the breakout traders took it up to there, but it didn't hold for some reason.
Hmm.
So, so the sellers magically disappeared, or excuse me, the buyers magically disappeared, and the sellers actually owned that day, right?
Yeah.
And they did it above this fairly strong up move, and they broke out of a range. So, so the sellers are definitely taking control there, right? The question is how much control? Because it could have been just for
Yeah.
that day, right?
Hmm.
So that's what's happened there. And just going to hit on the key points so we can get to the live chart. But Um, Bounces around. Here's another place where you can see there's this break of structure, right? But it didn't really break with a close above there. It broke with a wick. That's called wicking, right? Because it wicked that
Mhm.
area right there. And so you call it a manipulation because look what happened. It went up, it absorbed those breakout buy orders, and they actually were more sell orders going downward, right?
Mhm.
And now, oh look, isn't that right on the opposite of up here, right? And it's the opposite of that, right? Well,
Mhm.
when this is at the bottom versus the top, up at the top it's called a candle of shooting star. Down at the bottom, it's called a hanging man, or a long-legged doji. Kind of depends on the size of the body, but um,
Okay.
all these little terms, when you actually go look at the graphics, it helps you remember their purpose, right? But
Mhm.
when you first start hearing them, it's like it's just a bunch of names, right?
Yep.
But so at any rate, the same thing has happened here. It went down not only below that previous candle, but look, it went down below there as well, right? And popped way back up above that bottom, right? So you've got to be saying to yourself, right at this point, whew, somebody has been trapped right there. I've got a
Yeah.
higher probability of it going long. So what I would do in this case, if I was inclined to go long, um, I might personally be thinking this is too short of a run, right? But
Yeah.
let's just say you would say, okay, I want to buy above the high of this day. So as soon as this candle gets up above here somewhere, your order would kick in and then you would follow, then you'd be in, but your stop loss would be down below this point somewhere, right?
Mhm.
Because we know the manipulation happened right in here. So there's no reason to put a 15% stop loss when we know that the smart money was playing games right here. If it goes against that move, we're wrong.
Yeah.
GTFO. Right? Get the fuck out. GTFO.
Mhm.
All right? And so that's how you control it. That's how you become a risk manager is
So
by
we would put it like directly below the bottom of that wick.
yeah, let's just say the bottom of this is 100. You might put that at 99.50 or 99, right?
Okay.
I'll show you how to pick those points, right? When we get that
Mhm.
far, because again, psychology of this is people like round numbers, right? And they all follow lots of rules that are taught in classes. So some guys will say, put that stop loss 5% or 10% below this. Some guys say, put it 50 cents below on the dollar. Some people go, well, I'm just going to put it at a even 99. Well, the market makers and the smart money, they know this stuff. So they're going to go looking, what are people doing in that area? Oh, look, people are going to put their stop loss a buck below that. That's going to be obvious. So the next time they
Mhm.
get in that area, they're going to try to run it down to that obvious spot to see if there's any shares they can absorb and go the other way, right?
Mhm.
And if it turns out that it's really there's more sellers there than they had thought, well, they would just flip around and go with it, right?
Mhm.
They, you know, like you and I, we kind of need to be right more often than not. I mean, they do too, I guess, but we need to be more often than right so we don't lose too much at a time. But
Right.
they are so good at this that one, they don't lose very often, right? But when they do, they are managing their risk very, very closely because these guys that work at these prop firms, they can only lose so much per day and then so much per month. And if they go beyond those limits, they are not allowed to trade anymore with the firm's money. And then if they have what they call a net liquidity value in their account, and if they go below a certain percentage, they get fired, right?
Oh.
So, so as much as people go, oh, those guys got all the money, they also have a very high risk job because
Yes.
if if you make the wrong mistake, and that's why you become a risk manager, If you make the wrong mistake and you're fired, well, great. That doesn't help. It's great. You're
Yep. And
making
then other
five.
people know why you're fired and they won't hire you.
Yes, right. So, so, but you and I can take these techniques and use them in our favor and
Yes.
not get fired because we work for ourselves, right? But that's the goal is don't, you're always going to be losing some money on trades here and there because
Yeah.
you're going to make the wrong calls or something's going to happen and it's just going to be a fluke, whatever it is. That's the goal. Don't worry. Taking a loss at the right time quickly is right. It's not just making a profit is part of being right. The other half of being right is knowing when to GTFO, right?
Yeah.
And that's the goal. GTFO as fast as possible. And then, like here, if you were wrong, right, and you saw this happen, you could just immediately reverse your position, sell out, go the other way, right? That's called a reverse.
Hmm.
And that's what the big guys are very good at is going, I was wrong. Okay, great. Whatever. I'll go that way too. I'm fine. You know? And I've successfully done that a few times, but it's really hard. It's hard to change your position immediately from bullish to bearish or bearish to bullish, right?
Yeah.
Because I've gotten pretty good at expecting bearish or expecting bullish and being able to go quickly from there. But that reversal, that's still it's a big mind fuck, right?
Oh yeah. Well, it happens so quickly, right?
Yeah. But now if we're going to be working on like the daily chart and like say the 39-minute or the 30-minute, whatever, that doesn't move that fast. You'll be able to, look at it at night, go through it, etc., right? And then make a
Hmm.
decision. So in general, that's the case.
Yeah, and I think that's probably the route I'm more leaning towards anyway. So
Yeah, and for guys like us, we actually have to do that because
yeah,
we have a full-time job. We've got limited capital, right?
what we do.
Well, okay, I do, right? Right? And I don't want to make my limits smaller. I want to make my limits larger. And this actually, here's the tool. You see the pink and the green? This is actually a tool. Uh, it's called a short block, and you can also put in a long block where you're allowed to draw on the screen and you can manipulate where you want your stop loss and where you want your target so that it's visually going to happen in front of you, right? And then you
Yeah,
can
I
just
think
go,
you
oh
showed me how
shit.
to use that tool, but
Yeah.
now I think I actually know how to apply it
Yeah.
back to what we talked about with the stop loss. So
Yeah. So we'll do that again. So at any rate, but in the background, never forget about this concept, the lines and the break of structure visualized in this way, because
mhm.
it's real easy to get caught up in these little, hey, here's a manipulation, and start to forget about when you make a structure, a break of structure. And or do you have, one of these versus one of those? And this is part of my problem is I can get caught up in the minutia because I'm, learning that these details can be good, but we've got to really learn, focus on the overall structure of these swings, use the minutia to make your decisions, but they got to be at the same time. You can't, if you get focused on the minutia, you're gonna you're gonna just make the wrong calls, right? And
Mhm.
this I can tell you is true because I've done it and screwed it up many times. All right. All right. So I think that's the last generic image. Yes, it is. So now what I've done here is I
Can
have,
you put some of these images in the Discord
yeah, I'll put all
at some
those
point?
in there.
Okay.
I'll put them all in there. Um, because I've got, let's see, right now that's in there. In fact, where did I put that? Sample setups, right? I've got all
Hmm.
of these type of things. In fact, there's that this is the long box,
Yeah.
right? And so I got all these in here. I'll just toss them in here as well. Um,
Okay.
And we are at 45 minutes, so I'm going to stop the recording and restart it.